The worst housing crisis in our history happened during the Great Depression at the end of the 1920s to the early 1930s, and it is no coincidence that it coincided with a rapid downward freefall of the money supply, the exact same type of downward freefall that is happening right now. As home prices continue to remain at record highs, the question on everyone's mind is what is happening with the housing market? Are we careening towards the edge of a cliff, and is a crash inevitable? And while we can't predict the future with certainty, what we can do is look at current patterns, monetary policy, and understand how the contractions in place are going to impact not only real estate, but the value of the dollar in your wallet and what you can do about it. Hi everyone, I'm Taylor Kenny with ITM Trading. You asked, how are the current monetary policies going to impact the housing market? And we are going to go over that together today, as well as what you can do with that knowledge. Now, there are a lot of variables here. Interest rates are high and they're staying high. That's not new news. Everyone knows that. But what's not talked about enough is the money supply, and more specifically, the money supply's downward freefall that's been happening quietly in the background for the last year or so. But before we talk in specifics about the money supply, let's start with the housing market and where we are today. The average home price in the US increased from about $375,000 in 2020 to $525,000 in 2022. That was about a 40% increase in just 2 years. If you do the math and you take 20% down at a 3% mortgage rate on the house in 2020 versus a house today at, let's say, 7% mortgage rate, when it's all said and done, the monthly payment almost doubles. Yet 1 in 3 houses are still being sold for over asking price. How is this possible? Well, it all comes down to housing supply. We know that there's a limited supply, and it's because people are locked into their mortgages and locked into their homes. So even if they wanted to sell, they quite literally can't afford to. Not only because if they were going to go buy, it would be more expensive, but even rent has increased. So for everyone saying that the crash is happening right now, no, in order for a crash to happen, we have to have a lot of inventory available. And right now, supply is still limited. So the demand is there, supply is limited, regardless of the interest rates. And I don't see that changing anytime in the immediate. But that doesn't mean that the growth that's happened over the last 2 years is sustainable or even real for that matter. And this brings us back to the money supply. And when we talk about the money supply, for those of you who don't know, it's referring generally to how many dollars there are in existence. The money supply has a direct impact on tangible assets such as real estate or cars, as well as economic activity and inflation. Printing more money means that your dollars are worth less. Often the benefits are immediate, but they are temporary because pain will follow. Now, there's a huge lag that comes with the impact of changes to the money supply, typically 1 to 2 years. The lag isn't only long, it's also variable. And what I mean by that is that it's not only the length of time that can change, but the impact as well, because there are so many unknowns. When we look at an example like printing more money, this lag is hugely beneficial for the government because it gives them an opportunity to point fingers in all types of different directions. Oh, inflation is up. It could be because of corporate greed. It could be because of a war. It could be because of countless different things, when in reality, we know it all comes down to the money supply, which brings us to today. Right now, the goal of the Fed is to get inflation under control or reduce inflation. How do they do that? They have a couple of tools. Primarily, they're trying to reduce their balance sheet. They do that by shrinking their assets, letting their securities roll off. They also can, of course, raise interest rates, which they've done. And in turn, that actually prohibits or prevents as much borrowing, which in turn also impacts the money supply. What I mean by that is debt creates more dollars. I've explained how this works before in my How Banks Work video, but essentially as dollars are deposited into a bank, they are then loaned out, and through this process, more money is created. When rates are higher, there's less borrowing, which means there's less money being created. The cycle also works in reverse too. As debt is paid off, dollars are being removed from circulation. Long story short, prices become more expensive when there's more money supply because the dollar is worth less, just like prices become less expensive when there's less money supply because your dollar is worth more, which is exactly why the money supply right now is contracting because the Fed is trying to get inflation under control. Now, we know that there was an insane increase in the money supply from 2019 to 2021 of about 40%, and that's not even an increase or a spike, that's a rocket straight to the moon. Historically, when the money supply increases, economic activity increases, and then prices increase, which is exactly what we saw with the housing market that we went over earlier. So we can safely assume that the same home prices that went up as the money supply increased are going to come back down as the money supply begins to tighten and tighten and tighten, and that lag effect takes place. But if people are trapped in a mortgage at a lower rate, we might have a completely different situation than 2008. Instead of a ton of inventory, we might have people who are trapped in a home, trapped in a loan that is worth more than the actual value of their house. And this becomes even scarier when we know that Americans are more leveraged than ever before, with credit card debt at an all-time high and credit card usage up 8% from last year, with more and more people struggling to make their minimum payments. Another way to look at this is, let's say inflation persists, or it goes away and comes roaring back as many think it might. In that case, you might actually see home prices remain the same. The housing market might even continue to go up on paper. Nominally, the value will be increasing, but actually the value will decrease because your dollar is worth so much less. No matter how you slice and dice it, it would be foolish to think that the current monetary tightening isn't going to have a delayed effect on the housing market. And time is ticking. Time is ticking, and we will see these effects. Now, we all need a place to live and a roof over our head, but what I want to make sure is that everyone out there is making educated decisions based on the information available to them, because it has never been more important to have your wits about you to make sure that you are protecting your wealth and your family's wealth for future generations to come. Now, I haven't even touched commercial real estate in this video, which we know is so much worse than residential, and that is coming too. The true tragedy here is the everyday person losing everything because they're being told that, oh, it's all fine, soft landing, yada yada, when in reality, we're all familiar with the forever fallacy that you think just because prices are high today, they're going to be that way forever. It has always been disproven that that is just not true. So why? Why all this pain? Well, it's because it's Pandora's box. Once you play fast and loose with the economy and you make decisions like printing a ton of money and manufacturing low interest rates over a period of time, it's going to be the pendulum swing back the other way. They are trying to correct, some say overcorrect, what can't be corrected. The system is broken and they don't have a lot of options. Personally, I'm even less concerned with the housing market and more concerned with the value of the dollar that would be used to buy said house, or the dollar I stand to gain from selling said house, because as that value continues to decrease and diminish, what are we really left with? I've said it before, I'll say it again. This is why I personally strongly recommend that you have a strategy in place that isn't reliant on a fiat currency who's dependent on terrible monetary decisions and policy making. Because if it's all based on that fiat currency, you have no control over the true value of any asset that's associated with it. But listen, it doesn't have to be all bad news. I know so many people who are coming to me and realizing what's going on now. So if you don't know where to start, if you don't know where to begin, click the link in the description below, get a strategy in place today, and get started before it's too late. As always, I'm Taylor Kenny with ITM Trading, breaking down complex financial topics so we can learn and grow together. If you enjoyed this video, please like, subscribe, and share with your loved ones. It helps so much to get the word out. Until next time.